Hello, ladies and gentlemen, and welcome back. 2022 has been marked by inflation. Now we have the last central bank in the world admitting that it's real and that it's a problem. Yes, the Bank of Japan came out and changed their 10-year yield expectations. Basically, they widened the spread. This has dramatic ramifications across all markets to the tune of trillions of dollars. The question now is what happens next? And with so many people panicking and running around, can we figure out how to see the forest from the trees? Let's take a look now together to see how this really impacts all of us right now. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We'll be discussing the lead news, macro data, key indicators, and of course the big levels you need to be watching later on today's show. But let's begin with the big story. Bank of Japan, typical Bank of Japan style. Let's just come out and make a random announcement when we feel like it. Yes, that's what they've done now for pretty much over a decade. And what they've chosen to do is change and admit inflation is real. Basically, they've widened their Japanese 10-year from 0.25% to 0.5%. We'll look at the charts a little bit later on. But what does this mean? Well, first up, it pretty much tells us that the Bank of Japan is going to need to do some rate hikes, and they're going to do that during 2023. This fundamentally shifts so many things in the market. But your instant reaction yesterday or in the previous sessions, I'm sure, was we've got to short these markets. We've got to get out of stocks. Yeah, wait and hold on. Watch today's video because you're going to see that maybe the instant reaction to news is not the way that you should be thinking about this. So what's wrong with Japan? Well, they've got around 3% current inflation. That's a big issue. And of course, they're not really doing anything to necessarily combat that. Now they are. They've got a new governor coming in April of 2023, which most likely will allow them to do these policy shifts. And they've basically admitted they've got a problem. Now, this has been the worst central bank for literally 2 decades. And what they've done over in Japan is basically push monetary policy so far that it's a huge issue. By raising rates, they're going to have to pay more debt. And that's going to be the story that a lot of people are going to be talking about. Trillions of dollars at stake in terms of debt and now having to pay at higher yields. This will be something that does have ramifications onto things like US treasuries and other things over the long term. But let's have a look at the charts first. So first up, follow us at FX Evolution on Twitter. We'll be posting a lot more about the Bank of Japan story and of course all of our charts. And here's the big one, the JP10Y. Have it on your charts and you'll notice here the spike. Now, not to pick on anybody, but quite a few people were messaging me saying, look at what the Bank of Japan's done. It's a disaster. Everything's going to crash. And of course, at the time of this recording, we saw the markets fall, start to find some buying throughout, of course, the stock market day, which is traditional based on what we know about stats. And of course, we've now got a little bit of a buy up here in the futures with them going up around 0.5% in the current Asian into European session. So here's the JP10Y. You can see the huge spike here, basically where the pressure has been put on from 0.25. Now, we first talked about this story a long time ago back in May, and the pressure was being put on heavily in June and July for the Bank of Japan to have to make this move, to have to admit inflation was there. What will most likely occur now is we'll see things like JP, and you can put these ones on there, 02Y, so that's the 2-year yield, start to spike up a little bit. And Japan's run a negative interest rate for quite some time. So we're looking at now it having to go positive and potentially throughout 2023 start to move up into 1%, maybe even higher, to combat inflation to a degree. This is going to come at a cost, of course, to the world economy, especially from a debt standpoint. The normal synergies with Japan and debt and everything that's been traded now for well over pretty much a decade has now kind of been broken, and we're going to see that start to play out. Potentially weakness in the US dollar will also be a play. Now, were we already expecting weakness in the US dollar? Well, it seems like a few people are front running this particular trade because the US dollar has been weakening for a while now. That's off the back of also having to probably cut rates in 2023 from the Federal Reserve standpoint. And you'll notice that we're going into a kangaroo style time for the US dollar. We also know that we're seeing weakness in the market. Does that change as of this Bank of Japan statement? Well, nothing really changes here. we still already were thinking weakness. Part of it was one of these lead indicators, which is the MACD switch with the 200-day moving average turning down. This tends to have dire ramifications to the markets. And you'll notice when we get these types of reads, the next couple of months into 6 months can be very, very negative, or at least not necessarily a positive time for markets across the board. Everyone's expecting a Santa rally. Will we get one? Well, traditionally during bear market years, you don't get any Santa rally. We find ourselves here with a small uptick, usually coming into the back end of the year, and that's all it wrote. So it's not like those normal, beautiful Santa rallies that we traditionally get. We've been talking about this now on the channel for a little while. Without further ado, let's get into the charts. Let's talk about these lead indicators. Let's talk about what's the market's actually showing you. So first up, I see a lot of frustration out of people trading the VIX. Firstly, don't trade the VIX. I don't know why people trade this so much, but the main problem with the VIX is it's incredibly costly to trade. It has huge roll costs. The other problem is people expect that if you have a negative day on markets that the VIX must spike. That's not necessarily true. The VIX tends to spike a lot more when you go into uncharted territory. If you have a look at the SP 500 right now, although everyone's freaking out, it's just in a trade zone that it's been at many, many times over 2022 so far. So that's why you're not getting that huge spike in the VIX. Let's move over to some lead indicators though. Another down day for high yields. So this is junk bonds, HYG. It's basically telling us that the market doesn't like zombie debt. And I don't like zombie debt, and neither should you like zombie debt. Personally, zombie debt is very dangerous in 2023. So as we see this drop, if we continue to see this drop, even if we get a rally in the markets, and we barely get a rally here in HYG, this is going to be a teller that the rally is false. Pay a lot of attention to HYG over the next coming weeks or maybe even month. It's going to be a big play. So with the Japanese move, the Bank of Japan, what happened to treasuries? Well, initially, they got flogged. Basically, they went down about 1.78%. Now, part of this has to do with yields going up. We saw the US 10-year actually rise. I'll bring that onto the charts here. Just quickly with TLT, we always expected it to pull back down. And I think it's very important at these times to be able to see, again, the forest from the trees, to be able to make sense that this is actually still a pretty good level for treasuries, and the market is probably overreacting partially to this particular trade. Let's move over to the US 10-year and the US 2-year. So here's the 10-year. You notice the spike in the 10-year with the Bank of Japan basically saying, we can't hold it anymore. We need to give up on our 0.25 policy. What has happened? Well, it's moved a lot of inflation expectations, and we saw that rising across the board. Now, your initial reaction is probably, well, we should see the market to go down. Well, the market might be a little bit oversold, and we'll talk about that later. Remember, the initial reaction that you have is probably, well, it could be the right one, but at the same time, timing is everything. We saw the 2-year also hike up, and we saw expectations along the yield curve. So let's have a look now at 2023. We're still sitting at around a terminal rate of 4.8% from the Fed. So the expectation hasn't changed much on where the Fed has to go. It's just now debt is going to be more expensive across the world due to the Bank of Japan move. Let's move over to the US dollar. So a lot of people correctly think that this is going to affect the US dollar, and in fact, it's going to weaken it. Well, yes, it probably will weaken it over the longer term. However, we're here and now. So the initial expectation was weakness in the dollar, and we saw the dollar come back down. Now, we expected it to hit around this level anyway, and we're kind of playing with this idea of short-term strength here from the US dollar. Does that make sense? Well, it's right at that critical zone. I've got a little alert set here for this 104 level. And if 104 is broken, I think the US dollar has a little bit of legs in it initially. Now, you might think that's insane. How can it do that? Well, again, it has to do with where it's at already. It's already been heavily oversold now for weeks and weeks and weeks. And I'm not saying that US dollar may not have already finished and it's going down. In fact, the stats would prove that it's in a sideways style kangaroo market during 2023. Don't expect the US dollar to be as strong as it was during 2022 again. That was a miraculous time. It was the trade of 2022, but that is coming to an end. Now, where problems do arise has to be this chart. And it's because, look, we had short expectations for gold. full disclosure, we're absolutely medium term long on gold. We have been now for quite a few weeks, in fact, over a month, and we like gold a lot into what has pretty much again been admitted by the Bank of Japan, which is we're in worldwide stagflation. That's why people are making such a big deal out of this. What are the two best stagflation plays? Traditionally, it's gold, and traditionally it's silver. In fact, silver is an incredibly strong positional, and it had a great 24 hours. Now, gold has found itself back at this critical zone. Around here is where we thought gold would have problems, and it did initially. You can see the reaction to it was negative. We still probably maintain that there's a potential here for shorting off because of this false break, but you can't discount gold right now. The Bank of Japan's move is a big deal. It does prove that we're pretty much in a stagflationary environment, and this is one of the better styles of investments. So at this stage, yes, the market's on its tippy toes. If we do see dollar strength and we see that 61.8 fib hold up, then we probably do see some weakness here from the gold trade. But yeah, it was a very, very tough 24 hours for gold to be short that because of those reasons. Around here, though, still was a pretty good one. Obviously, those stop losses would be holding. It's now or never for gold, but don't discount it over the next coming months into the next, really 6 months. Because if we're in stagflation, or even if we're in an interest rate cutting environment with what we believe is probably currency wars going on in the world right now, gold is very attractive. For the first time in quite some time, it's very attractive. And with the base, with the money flow, with everything we've talked about in recent weeks, any pullbacks you would think are going to be met by demand. Let's just take a quick look at silver just to show the difference here. Silver actually did make a new high. It's a very beautiful accumulation pattern down here that broke out a few weeks ago, and it still looks very strong. It's obviously at a bit of a critical resistance, but if we do end up getting pullbacks, don't discount silver for 2023 or gold. I think they're going to be interesting investments. Let's move over here to US oil, at least in my personal opinion, yeah? Let's move over to US oil. What's going on here? Well, it's got a crisis. Look, we're definitely negative on oil, demand destruction and so forth. $65 has been our long-term target, 75 and 65. We've had that now on the channel since $120 per barrel. That's been my longer-term approach here. Now, we find ourselves at a very interesting point. While we still think 65 is possible, the short that came in here was correct. This was the downward trend line. Now we find ourselves in this ridiculous kind of pattern where you can see it sells the top and it buys the bottom. Could we see weakness? Well, I think if we make a new low here, we probably do. So let's put a little alert there at 74.40 from a technical perspective, and kind of know that if the market does come down here, maybe the battle has been won by the bears and it continues in the direction of trend. We cannot discount the fact that trend is currently down, but the short time frame trend is neutral to up. So that is when we broke through here, although we then went short, because we've rallied off this point and we're putting pressure on here, if we break past 78, we have to think that maybe oil has legs to 82 again. And then we'll find out whether it wants to go bearish. So 78 into 82, or new lows, hopefully 65. Hey, I can't say no to 65. I've been rubbishing on about that for a long time. Speaking of rubbish, no, just joking. Tesla, unfortunately, has fallen down, or fortunately, I guess. Look, this is pretty much spot on what we hoped, which was 136. Full disclosure, I do have a Tesla vehicle, so it's not like I'm an absolute hater. But yeah, the stock is getting beaten down, and it makes a lot of sense. High ticket items, consumer discretionary. We've been talking about it being a problem for a long time. And specifically Tesla, when it fell from here down to 180, we saw that rally around that point, and then we've unfortunately been pretty negative on it since. Now, of course, the main stories to make the bull case would have been Elon Musk stepping down potentially as head of Twitter. It looks like that's a thing now because of the vote. Maybe that's a positive for Tesla stockholders. But look, the fact is that it's kind of in capitulation now. It's starting to fall at a rate that's very extreme. We saw 8% down on the session. Do we expect a bounce around this zone? Well, it was our first target. So yes, we probably do. Do we have any reason to say that yet? No, you're literally just buying literally a falling knife, but that's sometimes what it takes when it comes to these types of stocks. Now, we can use the options market to try to figure out whether it should be down in these levels. Let's do that together right now. So the 23rd, this is the Friday options expiration. Unfortunately, a lot of people have calls. They're probably going to lose those positions. 160 and 170. We never had the expectation it could go past that this week. And the puts are pretty seldom in comparison. Max Payne's at 155, but don't worry about that. We just don't want to pay these out.